52.63 million ounces demanded, 81.73 million ounces available. I want you to do that math right now before I say another word, because that ratio, sitting in the official published CME Group warehouse data as of March 9th, 2026, is not a prediction. It is not a theory. It is not something I pulled from an anonymous corner of the internet. It is the live, publicly available, legally certified delivery data from the largest silver futures exchange in the Western world. 64% of every single deliverable ounce in those vaults was spoken for in one contract month. 1 month. And those numbers are not from last quarter. They are from this week. Now here's the question nobody in financial media is asking. The CME Group raised margin requirements from 15% to 18% in mid-February. Silver crashed 41% in under 30 hours, from 121.67 to below $70. The margin hike worked, the leverage got destroyed, the speculative overlay got wiped, but the vaults kept draining. Not 1 ounce of new registered silver appeared after that crash, not 1 vault replenishment, not 1 counter-trend replenishment in the week since. The margin hike reset the paper price, it did not reset the physical reality, and the distance between those two things, between what the paper market says silver is worth and what the vault data says about how much silver actually exists to deliver, is the only number that matters for the next 60 days. This is John A.G. here. Before we go one sentence further, I sell nothing. No course, no premium Discord, no signal service, no newsletter behind a paywall. Zero. The raw data and the full analysis live here on this channel, and that will never change. If what you're about to hear changes how you read these markets, subscribe and drop John A.G. here in the comments so I know exactly who's in the room, because what I'm about to lay out over the next 20 minutes connects data points that the mainstream financial press has not connected, not because they cannot find them, because connecting them honestly leads to a conclusion their advertisers would prefer you never reach. Part 1, the 41% crash, what actually happened and what it didn't change. Let me reconstruct the timeline precisely, because the sequence matters more than any single number. January 29th, 2026, silver touches $121.67 per ounce, an all-time nominal high, a number that would have seemed laughable to any analyst 14 months earlier when silver was trading below $30. The rally that produced that print was extraordinary. Silver gained 68.5% in the single month of January alone, 68.5% in 31 days. Then in mid-February, the CME Group made one decision. They raised margin requirements from 15% to 18%, 3 percentage points. That is all it took. What followed was not a market correction. It was a leverage liquidation cascade. Funds carrying leverage long positions could not meet the new collateral requirements. They were forced to sell, not because they changed their view on silver's fundamentals, not because the vault data improved, not because the deficit disappeared, but because the exchange changed the rules of the game while the game was being played. London silver fell to 71.67, a 41.1% drop from peak to trough in less than a trading session, 41.1% in hours. Now here's the part that should be sitting uncomfortably in the back of your mind. The margin hike worked on the paper price. It worked completely. Silver went from $121 to $71 in under 30 hours. The speculative overlay was destroyed, but pull the CME Group warehouse reports from the day before the margin hike and compare them to the reports from the day after the crash. The registered silver inventory did not go up. It went down. A single-day report from Comex warehouses on February 11th showed a negative adjustment of 3,568,200 ounces in the registered category, nearly 3.3 million ounces removed from deliverable status in one trading day. While the paper price was being demolished, institutional actors were pulling physical metal out of the vaults as fast as the system would allow them. The crash reset the paper price. It did not reset the physical demand. Those are two different things, and confusing them is how retail investors get destroyed in this market every single cycle. Part 2, the 6-year drain. What 64% actually means. Let me give you the full historical weight of the Comex registered inventory number because the way this data point is being reported dramatically understates its significance. April 2020, Comex registered silver inventory 240 million ounces. That was the baseline. That was the buffer. That was the pool of physical metal the exchange had available to guarantee delivery against futures contracts. March 9th, 2026. Comex registered silver inventory, 81.73 million ounces. That is a 64.1% drawdown across 6 years. Not 64% in one bad month, not 64% during a single crisis event. 64% across 6 years of persistent, session-by-session, vault-by-vault drainage with almost no counter-trend replenishment. Now add the delivery data on top of that drain. In January 2026 alone, 1 month, Comex processed 49.2 million ounces of physical silver delivery. That is 10 times the delivery volume recorded in January 2024, not 10% higher, 10 times. February added another 25.18 million ounces, the highest February delivery volume in modern Comex history, 5 to 8 times historical norms for what is typically the lightest delivery month of the year. Combined January and February 2026 Comex delivery total 74.38 million ounces in 60 days. For context, that is approximately equivalent to the entire annual silver production of Peru, the second largest silver producing country in the world, being demanded from and delivered through a single exchange in 2 months. And who was demanding those deliveries? Not speculators. The managed money positioning data is precise on this point. Speculative managed money contracts fell from 54,415 contracts in February 2025 to 12,121 contracts in February 2026, a 77.72% collapse year over year. The speculative overlay was not buying these deliveries. It was liquidating. The 74.38 million ounces were demanded by industrial users and institutional investors who were not rolling their contracts. They were standing for physical delivery. They wanted the metal in their hands, not on an exchange ledger, not as a paper promise, not as a futures contract that could be cash settled at the discretion of the exchange. They wanted the bars. When the market's speculative layer is collapsing 77% and the physical delivery demand is simultaneously at all-time records, those are two independent signals pointing in the same direction. The speculation was not the story. The physical demand underneath the speculation was always the story. Part 3. China's export controls, the supply corridor that closed on January 1st. Here is the variable that most analysis of the Comex drain is missing entirely, and it changes the entire context of everything I just showed you. On January 1st, 2026, the Chinese government implemented strict export controls on refined silver. One date, one policy decision. And the effect on Western exchange vaults has been profound and permanent. Before those controls, the silver market had a self-correcting mechanism. When prices diverged between New York and Shanghai, physical metal would move through arbitrage flows. Silver would flow east when the premium justified it, west when the premium narrowed. The system would rebalance, the vaults would replenish, the delivery mechanism would stay functional. That mechanism is now broken. As of today, the Shanghai Gold Exchange is showing a persistent premium of $8 to $13 per ounce over New York Comex prices. That gap is not being closed by arbitrage. It cannot be, because the metal that used to flow in that arbitrage is now locked inside Chinese borders by government decree. What this means in practice is that the physical silver market has bifurcated into two distinct pricing zones, one in the east and one in the west, and they are no longer connected by the physical flows that used to keep them aligned. The Comex is not just dealing with domestic American demand. It is now absorbing the full consequence of losing an entire continental supply corridor that it had depended on for decades. The Shanghai Gold Exchange silver inventory as of early February 2026 stood at 10.24 million ounces, its lowest level since 2015. The Comex drain is not happening in isolation. It is happening simultaneously with an eastern drain. Both vaults, both directions, same metal, same deficit, no arbitrage to rebalance either. Part 4. The structural deficit, 6 consecutive years. Now let me put the Comex mechanics inside the broader supply and demand structure, because the delivery story does not make its full weight felt without this context. The Silver Institute confirmed in its February 2026 annual outlook that the silver market is heading for its 6th consecutive year of structural deficit in 2026. Not 1 year of deficit, not 2, 6. Every single year since 2021, the world has consumed more silver than it has produced. The cumulative deficit across 5 years through 2025 is estimated at approximately 820 million ounces. For 2026 specifically, total global silver supply is forecast to reach 1.05 billion ounces, a decade high, up 1.5% from the prior year. Mine production projected at 820 million ounces, up 1%. The supply side is not collapsing, and yet the deficit persists at 67 million ounces because the demand side has fundamentally shifted in character in ways that the models built 2 years ago did not fully anticipate. Physical investment demand is forecast to surge 20% to 227 million ounces, a 3-year high. After 3 consecutive years of declining investment demand, Western buyers have come back hard. But here is the demand driver that changes the entire trajectory of this metal over the next decade, and it is not the one most retail investors are focused on: data centers, artificial intelligence infrastructure. The next generation of server builds, liquid cooling systems, and high-conductivity electrical components require silver in quantities that were simply not being modeled into demand forecasts as recently as 2023. AI buildout is now a structural long-term demand driver for silver that the Silver Institute itself has confirmed. A hyperscaler building a 500-megawatt AI campus does not reduce their silver specification because the price moved from $30 to $89. They buy what the engineering design requires. That demand is inelastic in a way that jewelry demand and silverware demand are not. And on the solar side, the narrative is more complex than most people present it. Silver paste costs per 450-watt solar module have increased from roughly $522 in early 2025 to approximately $1,765 by early 2026, a 238% cost increase. The solar industry is actively accelerating its shift away from silver through thrifting and substitution. Photovoltaic demand is expected to fall in 2026 even as global installations continue rising. So here's the tension. Solar is pulling back. Mine production is at a decade high, recycling is growing, and yet the deficit is still 67 million ounces for the sixth consecutive year, because the demand from AI infrastructure, EVs, semiconductors, and physical investment is not just replacing lost solar demand, it is running well beyond it. Part 5. What the margin hike actually accomplished, and what it left untouched. Let me show you exactly what the CME's margin hike from 15% to 18% accomplished, and more importantly, what it did not touch, because this distinction is the entire key to reading the next 60 days correctly. What the margin hike accomplished, it destroyed the speculative overlay. It forced leveraged long positions to liquidate. It reset the paper price from $120 to $71 in under 30 hours. It generated the largest single-session silver price collapse in modern exchange history. It scared retail investors out of positions. It handed every advantage to institutions with direct market access who could repopulate their order books in milliseconds, while retail traders were still reading the notification that margin requirements had changed. What the margin hike did not accomplish, it did not put one single ounce of new registered silver into Comex vaults. It did not close the $8 to $13 Shanghai premium. It did not reverse China's export controls. It did not address the sixth consecutive year of structural deficit. It did not stop industrial users from standing for physical delivery in January and February at the highest rate in exchange history. It did not replenish the 64% of registered inventory that has walked out of those vaults since 2020. The margin hike was a financial instrument applied to a physical problem. It worked on the financial side. It did nothing to the physical side. And the physical side has not paused, has not slowed, has not given any indication that it intends to resolve itself on a timeline that is convenient for exchange operators. Now here's the question that should be keeping the CME's metals division awake at night. The margin hike from 15% to 18% produced a 41% paper price crash. That same tool has now been used. The leverage has been reduced. The speculative overlay has been cleared. If registered inventory continues declining from 81.73 million ounces toward 60 million, toward 50 million, and the delivery demand that showed up at the rate of 74.38 million ounces in 60 days shows up again in April and May, what financial instrument does the exchange reach for next? Margin hikes work on leveraged speculators. They do not work on industrial users who need physical silver to build solar panels and AI servers and electric vehicles. Those buyers do not care about margin requirements. They care about whether the metal exists. Part 6. The SLV signal and what institutional behavior is communicating. Here's a data point that most retail investors are not combining with the vault drain, and I want to show you why it belongs in the same analysis. The iShares Silver Trust, SLV, as of March 9th, 2026, recorded a one-year total return of 171.27%. Its 52-week range runs from $27.46 at the low to $107.35 at the high. Those are extraordinary numbers for an instrument that most people still think of as a conservative metals allocation. But here is what the Comex stress data adds to the SLV picture. Global ETP holdings currently stand at approximately 1.31 billion ounces. Consider what a 5% redemption wave looks like in that context. 65.5 million ounces looking for physical delivery simultaneously. Against Comex registered stocks of 81.73 million ounces. That math does not resolve quietly. That is not a prediction. That is arithmetic. The Sprott Physical Silver Trust has been trading at a premium to its net asset value, precisely because investors are seeking guaranteed physical backing in an environment where the guarantee chain from paper to physical metal is under visible strain. That premium is not irrational. It is a real-time market signal that physical metal commands a valuation that paper-backed instruments cannot fully replicate. And then there is the institutional behavior that speaks louder than any analyst price target. The Wheaton Precious Metals streaming deal, $4.3 billion with BHP covering the Emamina mine. Pan American Silver guiding 25 to 27 million attributable ounces for 2026. You do not sign a $4.3 billion streaming deal if you believe silver is going back to $50 in 6 months. Institutional capital is communicating something through its behavior that analyst price forecasts are not communicating through their published numbers. Watch what institutions do, not only what they say. Part 7. The honest bear case. I always give you both sides, because anyone who only gives you one direction is not educating you. They are recruiting you. Bear argument 1. The 41% crash was the confirmation, not the exception. Silver went from 121.67 to below $72 in under 30 hours. That is what speculative bubbles do when they unwind. The physical delivery data is real, but the crash itself proved that a significant portion of the move to $121 was leveraged paper-driven speculation that the fundamentals could not sustain at that pace. If the speculative overlay can add and subtract 50 points from the price in a single session, the structural deficit narrative does not protect you from that volatility. Bear argument 2. Marko Kolanovic, former chief global strategist at JP Morgan, one of the most widely followed macro analysts in the world, has been explicit. He sees silver trading back toward $50 per ounce later in 2026. His argument is not based on supply-demand fundamentals. It is based on market structure. His view is that moves of this character attract speculative capital, what he described as meme traders attempting to take over the market. And speculative capital is not permanent capital. It rotates, it panics, it liquidates. The CME's margin hike was precisely the kind of pressure that triggers that rotation, and it worked for 40 days. The question Kolanovic raises, could it happen again? Bear argument 3. Solar thrifting is real and potentially accelerating. Industrial silver fabrication is forecast to decline 2% in 2026. Jewelry demand is down over 9%. Silverware demand is contracting 17%. These are demand destruction signals that the bullish case cannot simply dismiss. If substitution technologies in solar mature faster than expected, the industrial demand pillar that underpins the silver bull case weakens structurally, not just cyclically. Bear argument 4. The CME has tools it has not fully deployed. The exchange has never defaulted in its history. The delivery stress we saw in January and February was managed through normal exchange mechanics. Those who predict imminent Comex default have been predicting it for years without it materializing. Stress in a delivery system is not the same as failure of that system. These arguments deserve weight. The bear case is mechanically coherent. But here is what it cannot account for. The 74.38 million ounces physically delivered in January and February were not delivered by speculators. Speculators do not stand for delivery. They roll their contracts or close their positions. Industrial users and institutional investors stood for physical delivery and took the bars into their own custody. That behavior does not emerge from speculation. It emerges from entities that have assessed their supply chain and concluded that metal in hand is worth more than a promise to deliver metal later. Both the bull case and the bear case agree the Comex registered inventory at 81.73 million ounces is historically low. Where they disagree is whether that low inventory is temporary or structural. 6 consecutive years of deficit, a 64% vault drain, and China's permanently closed export corridor all point in the same direction. Part 8. 3 scenarios through end of Q1. 3 specific scenarios with honest probability assessments for the rest of March 2026. Scenario 1, the engineering holds, most likely in the short term. The CME continues managing delivery pressure through contract rolling incentives, cash settlement options, and the threat of additional margin adjustments. Silver consolidates between $84 and $95 through the rest of March. The registered inventory continues declining, but at a pace the exchange can manage session by session. The real stress becomes visible in April and May when the next front-month delivery cycle opens against a vault that has been further drained by March's final delivery tally. Scenario 2, physical demand overrides engineering. The March delivery cycle final tally comes in above 40 million ounces. Combined with January and February, that puts the Q1 total above 114 million ounces against a registered inventory that started the year above 100 million and is now at 81.73 million and falling. The paper ceiling at $92 to $95 that has rejected silver multiple times breaks with conviction. Next objective on the tape is $115 to $121, the January high retest. The 6-year deficit narrative goes mainstream. Scenario 3, dollar strength resets. The paper price again. The Fed signals a hawkish hold at the March 18th meeting. CPI data between now and April comes in hotter than expected, not because of oil, but because of services and shelter inflation that was already sticky before the war. The DXY strengthens back above 100. Paper sellers get a narrative window and use it. Silver tests $75 to $79 again. The physical floor holds, as it has held every previous flush. But retail investors who bought the recovery get shaken out a second time. The closing data stack. Here is where everything stands right now. Pull every number yourself. Every single one of these is publicly available and free. Comex registered silver inventory, 81.73 million ounces, down 64.1% from 240 million ounces in April 2020. January 2026. Comex deliveries, 49.2 million ounces, 10 times January 2024. February 2026. Comex deliveries, 25.18 million ounces, 5 to 8 times historical February norms. Combined Q1 delivery demand through first notice day, 74.38 million ounces plus 52.63 million ounces standing for March delivery. Shanghai Gold Exchange premium over Comex, $8 to $13 per ounce. Persistent, not closing. Shanghai Gold Exchange silver inventory, 10.24 million ounces, lowest since 2015. China silver export controls, effective January 1st, 2026. Arbitrage mechanism broken. Silver Institute 2026 deficit forecast, 67 million ounces, 6th consecutive year. CME margin hike, 15% to 18%. Paper price impact, 41% crash in under 30 hours. Physical vault impact, 0. Drain continued. Silver price today, $89 and climbing, up 171% year over year, up 20.5% from January 1st, even after the 41% crash from the all-time high. Pull the CME Daily Warehouse Report tonight. Look at the registered column. Not eligible, not total, registered. That is the only number that matters for delivery capability. Watch it over the next 2 weeks. The March delivery cycle is not over. Every ounce that leaves the registered column is one fewer ounce standing between the current pricing structure and a reckoning that financial engineering can delay but cannot permanently prevent. The margin hike reset the paper price. It did not reset the physical reality. Both of those things are simultaneously true. Hold them both. If this changes how you see what is unfolding in these markets, hit the like button. Share it with someone who thinks the 41% crash means the silver story is over. Subscribe if you haven't. Because when the registered inventory number breaks below 60 million ounces and the conversation finally reaches mainstream financial media, this channel is where the full breakdown landed first. Unfiltered, unsponsored, free. Drop John AG here in the comments. Not because I am counting, because it tells me you sat through every data point, every bearish counter-argument, and every question this video raised, and you are still here. That is the audience this channel is built for. This is financial warfare education. It is not investment advice. Invest with logic, never with emotion, never with impulse decisions. Be smart, stay vigilant. OG John AG signing out. The margin hike reset the paper price. The vaults kept draining. One of those two facts will define this market. The other was just a delay.